Hey everyone, and welcome back to the channel. Today, we're diving deep into something absolutely fundamental for any trader: chart patterns. Think of these as the language of the market. If you can learn to read them, you can start to understand what the price might do next. It's like having a treasure map, but for trading. We'll cover some of the most powerful and common patterns out there, like the double top, the head and shoulders, and flags. And most importantly, I'll show you how to tell a real signal from a fake one. So, grab a notepad, because this is a lesson you won't want to miss. First up, let's talk about reversal patterns. These are formations that signal a potential change in the current trend. One of the classic reversal patterns is the double top. Imagine a price climbing up, hitting a resistance level, and then pulling back. It tries to rally again, hits that same resistance level, but fails to break through. This creates two distinct peaks at roughly the same price level, looking like the letter M. What does this tell us? It suggests that the buying pressure is running out of steam. The bulls tried twice to push the price higher and failed. This is a bearish signal, meaning the price could be about to reverse and head downwards. Now, for a double top to be confirmed, we need to see a break below the neckline. The neckline is the support level formed by the low point between the two peaks. When the price closes decisively below this neckline, it's a strong confirmation that the uptrend is over and a new downtrend is likely beginning. This is where many traders would look to enter a short position. And here, as a pro tip, the potential price target for the move down is often estimated by measuring the distance from the peaks to the neckline and projecting that same distance downward from the breakout point. Of course, what goes up can also come down, and that's where the double bottom comes in. It's the mirror image of the double top and is a bullish reversal pattern. It looks like the letter W. The price is in a downtrend. It hits a support level, bounces up, pulls back down to that same support level, and then bounces up again. This shows that the selling pressure is weakening. The bears tried to push the price lower twice, but the support held strong. This suggests the buyers are starting to take control. Just like the double top, confirmation is key. For the double bottom, we look for a breakout above the neckline, which is the resistance level formed by the peak between the two bottoms. A solid close above this line confirms the pattern, signaling that the downtrend is likely over and a new uptrend is starting. This is a potential entry point for a long position. The price target can be estimated in the same way. Measure the height from the bottoms to the neckline and project that distance upwards from the breakout. Remember, these patterns are about the psychology of the market, the battle between buyers and sellers. Now, let's move on to another famous reversal pattern: the head and shoulders. This one sounds a bit strange, but it's incredibly powerful. This is a bearish pattern that signals the end of an uptrend. It consists of three peaks. The price rallies to a first peak, the left shoulder, then pulls back. It then rallies to an even higher peak, the head, and pulls back again. Finally, it rallies one last time to a third peak, the right shoulder, which is lower than the head and roughly in line with the left shoulder. If you connect the low points of the pullbacks after the left shoulder and the head, you get the neckline. The logic here is that the uptrend was strong enough to make a new high, the head, but the subsequent rally, the right shoulder, failed to surpass it. This is a major sign of weakness. The confirmation for a head and shoulders pattern comes when the price breaks below the neckline. This is a strong signal that the trend has reversed and prices are likely heading lower. Traders often look to short the market after this neckline break. And just like with the double top and bottom, there's an inverse version. The inverse head and shoulders is a bullish reversal pattern that forms at the bottom of a downtrend. It looks exactly like the head and shoulders pattern, but flipped upside down. You have a first trough, the left shoulder, a deeper trough, the head, and then a third, shallower trough, the right shoulder. The neckline is drawn by connecting the highs of the bounces between the troughs. When the price breaks out above this neckline, it's a strong signal that the downtrend is over, and a bullish move is on the horizon. This is a classic long entry signal for many traders. So we've covered reversal patterns. But what happens when the market is just taking a breather before continuing its original trend? That's where continuation patterns come in. And one of the most common and reliable continuation patterns is the flag. Imagine a strong, sharp move up, like a flagpole. After this big move, the price enters a period of consolidation, drifting slightly downwards in a tight, parallel channel. This channel is the flag. This consolidation is just a market catching its breath. It shows a temporary pause, not a reversal. The bullish flag pattern is confirmed when the price breaks out of the top of the consolidation channel. This signals that the brief period of profit-taking is over, and the original uptrend is ready to resume. Traders will often look to enter a long position on this breakout. A common way to project a price target is to measure the height of the original flagpole and add it to the breakout point of the flag. This gives you an idea of how far the next leg up could go. On the flip side, we have the bearish flag. This occurs during a downtrend. You'll see a sharp, steep drop in price, the flagpole, followed by a period of consolidation where the price drifts slightly upward in a tight channel, the flag. This slight upward drift is a weak rally, a brief pause in the overall downtrend. It's the bears taking a short break before pushing the price lower again. The pattern is confirmed when the price breaks down below the bottom of the flag channel. This is a signal to traders that the downtrend is resuming, and it presents a potential short entry. The price target is calculated similarly. Measure the flagpole and project that distance down from the breakout point. Now, this is the most critical part of the entire lesson. Identifying a pattern is one thing, but confirming it is what separates successful traders from those who get caught in false moves or fake. So, how do we confirm a breakout? The single most important tool for this is volume. Volume represents the number of shares or contracts traded over a period. It shows us the conviction behind a price move. Let's think about a breakout from a double bottom, a bullish pattern. As the price approaches the neckline, we want to see volume start to pick up. Then, when the price breaks through that neckline, we want to see a significant spike in volume. A high volume breakout tells us that a lot of traders are participating. Big money, institutional players, they're all jumping in. This high conviction adds a huge amount of credibility to the breakout. It's the market shouting, "Yes, we're serious about this move." Conversely, what if the price breaks the neckline, but the volume is low or decreasing? That's a huge red flag. A low volume breakout is weak. It suggests there isn't much conviction or participation behind the move. It's much more likely to be a fakeout, where the price pokes through the level only to quickly reverse and get sucked back into the pattern. Many novice traders get trapped here, buying a breakout that has no fuel in the tank. Always look for volume confirmation. A real breakout should be accompanied by a powerful surge in volume. The same logic applies to all breakouts, whether they are from head and shoulders, flags, or any other pattern. For a bearish breakdown, like the break of a head and shoulders neckline, you also want to see an increase in volume as the price breaks down. It shows strong selling pressure and conviction from the bears. While some say volume is less critical on breakdowns than breakouts, a surge in selling volume is still a very powerful confirmation signal that you shouldn't ignore. So let's recap the key takeaways. We've learned to identify powerful reversal patterns, like the double top and bottom, and the head and shoulders. We also covered the flag, a classic continuation pattern. But the golden rule that ties it all together is confirmation. A pattern isn't complete until the neckline or trend line is broken. And the best way to confirm that breakout is with a significant increase in trading volume. Volume is your truth detector. It helps you distinguish a genuine, high-probability move from a deceptive fakeout. Practice identifying these patterns on historical charts and pay close attention to the volume on the breakouts. This will build your confidence and your skill as a trader. That's all for today's deep dive into chart patterns. I hope this gives you a solid framework to start analyzing charts with more confidence. If you found this video helpful, please give it a thumbs up. And do you forget to subscribe and hit that notification bell so you don't miss our future trading lessons. Let me know in the comments which pattern you find most reliable in your own trading. Thanks for watching, and I'll see you in the next video.